Hey everybody, it's Christian Madarasz, and this is chapter 2. I know I sent a video earlier, however the sound was horrible. So I'm going to redo this video and hopefully give you some more insight into what's going on. So in this chapter, we're looking at debits and credits and going through the process of analyzing transactions and figuring out actually how this bookkeeping stuff works. So if you'll follow along with me, the one thing we're going to use a lot of in this course are called T accounts. And the T account is simply put an item that looks like the letter T, and it represents the general ledger accounts. So the general ledger is historically was a set of books with pages. Each page would have one of the different accounts. So there'd be a cash account, an inventory account, accounts receivable, different expense accounts. And the bookkeeper or the accountant would journalize everything into these books. So as we're going through, we're using Excel sheets to simulate these book pages, and computer programs actually take care of all this stuff in the background when you go into the computer adds accounting course. But for now, to learn the bookkeeping method, we go through a process of applying pen to paper or keystrokes to Excel sheets and get the information in from there. So the T account, normally what we do is we have the title of the T account on top, and then the left side, or the debit side, would be where we record debit entries, and the right side, the credit side, would be for credit entries. And here's a sample of the general ledger account and what it looks like. So you'd have the account number, the account name, the account number on the other side, as well as the date of the transaction, the posting reference, which you'll learn about later on in the course. This is saying where the entries are coming from. And then here's the T, which has the debit entry. So this would be $180 debit to the telephone expense. And then we would carry over and say, here's the balance. This debit or credit isn't what the transaction is. It's actually what this balance is. So in this case, it's a debit balance of 180. As you go through the process, so here's my T account again, there's a couple debit entries coming in. So cash coming in of 4,000, cash coming in of 500. There'd be somewhere else in another T account, there'd be an offsetting credit entry for these, but this is just looking at the cash account. There's a payment for $300 for an expense, a payment to a creditor for an accounts payable. After these entries go through, we total up what's happened, and these are called the footings. So we foot the ledger, and this is to help us add up our debits and our credits, and then we figure out the balance of the T account. So footing is figuring out the total of the debits and the total of the credits, because as we're going through all these different accounts and adding debits and adding credits together, in the end, the total of all the debits should equal the total of all the credits. And then you know you're in balance. If it doesn't balance, that means there's an error in the book somewhere. Okay. So the rules of the debits and the credits, I was talking to somebody on the phone today and I said, this is a tool here, this basic accounting equation that you went through in in chapter 1, that it's supposed to help students understand the whole idea of balancing the equation and how things work. I find it sometimes confusing for students. So the main tip that I can offer you, the first tip, is that when you're looking at debits and credits, think about the way the bank account will work. So that in the bank account, in the cash account, when there's a debit, it increases the balance of the cash account. When there's a credit, it decreases the balance of the cash account. Okay, so that's the very first tip I want you to think of, is how is the cash account affected? If you learn that, then everything else can fall into place, because with debits equaling credits, when you know the bank account, you can figure out the other side, because it'll be the opposite. If the bank account is a debit and you know that the other account that's being affected is revenues, then there'll be a credit entry. This is just a horribly confusing mess, but what this is saying is that inside the capital account, once everything's taken care of with the revenues, if there's a revenue increase, then it's a credit. Here it says if there's expenses, there are debits. If there are withdrawals, there's debits. But trust me on this one, think about for now what's happening with the cash account, and everything else will fall into place. And again, if you're feeling a little bit confused, that's okay. That's exactly where you're supposed to be in chapter 2. You're supposed to be feeling a little bit overwhelmed and a little bit confused, because all of this stuff is new. For some students, They like to recognize the normal balances. So that's a term that you'll have to be familiar with. The normal balance is, in an ideal world where everything is happening, the bank account would have a positive balance. We wouldn't be in overdraft. So the normal asset balance would be a debit. The normal expense balance is also a debit. So that's the second tip. When you're doing expense entries, more often than not, and there are some exceptions that you'll encounter later on, but let's say 99% of the time, if you're doing an expense entry, that will be a debit entry. If you're looking at your chart of accounts, at your trial of balance, at your income statements, at your general ledger accounts, and you're going through and you see expense accounts that have a credit balance, that normally means there's something wrong, okay? So also within the chart of accounts, we use a numbering system. And in the book, we use a 3-digit numbering system. So all of the assets are in the 100 range. The liabilities are in the 200s. The owner's equity accounts are in the 300s, revenues are in the 4s, and expenses are listed in the 5s. So a chart of accounts would have the account numbers listed, as well as the account description, the names. The balance sheet accounts are the 100s, the 200s, and 300s. And the income statement accounts are the 4s and the 5s. Okay? The balance sheet accounts, and you'll learn this a little bit later on, are called the permanent accounts, and the income statement accounts are the temporary accounts. So I'm just planting the seed because you'll hear about this later on. I'll skip that. Basically, what's happening in a compound entry, I'll back up there, is that a compound entry means that there's not just one transaction. So in this example, it says there was a piece of equipment that was purchased for $10,000 value, and to pay for that equipment, they paid $5,000 cash on the spot, and then they said, you know what, I'll owe you the other $5,000. So this compound entry says, here's the debit for equipment, here's the credit for cash, and here's the credit for accounts payable. So understanding how the cash account works, if I know that I paid $5,000, I know that the bank account went down $5,000, that means that the credit for cash is $5,000. Okay, so learn that bank account. What happens there? And then the thing with the bank account is that it's indicative of almost all the asset accounts. So if the cash account is going up, that means it's a debit. That means other assets, if they go up in value, they're also debits. So the equipment would be a $10,000 debit. Now I've got a $10,000 debit and a $5,000 credit. My account payable number would have to be $5,000 credit, because when I add up all the debits, when I foot the debits and I foot the credits, I have 10,000 in debits, 5 plus 5 is 10,000 in credits, my books are in balance, okay? I'm talking pretty fast because I'm trying to make this a short video. Hopefully it all makes sense, and we'll carry on. Problem 2-5B. So in your book on page number 84, page 84, there's a series of transactions from starting at A to K. And when you're going through these transactions, there's transaction analysis. And this is actually something I take for granted now because it's so ingrained in me. But there are steps. So the first step is ask yourself which accounts are being affected. So in the previous example, I asked myself which accounts are being affected. I bought some equipment. So the equipment account, I paid cash, and I owe somebody. So there's 3 accounts being affected: equipment, cash, and accounts payable. That's the analysis part. What categories do they belong to? Well, the cash category is an asset. The equipment is something that I own, so that's an asset. And the accounts payable is going to be something that I owe, that's a liability. Determine whether the accounts increase or decrease. Well, my equipment's going up, and my cash is going down, so it's decreasing. And my accounts payable, my liability, is increasing. So, got 2 that are increasing, 1 that's decreasing. Okay. What do the rules of debits and credits say? Oh, there was that, if I remember, there was that table that says if assets are going up, how does my cash account work? If assets going up as a debit, assets going down as a credit. So I've got my equipment is going up, that's a debit. My cash is going down as credit. Okay, I can't remember what it says about the liabilities though, but I know that my debits have to equal my credit. So if I've got my equipment is 10,000 going up, that's a debit, and then my 5,000 is a credit, then the other entry has to be a credit. So that's what I mean. If you figure out the cash part and figure out how the assets work, you can often piece it together and figure out the third part without having to remember the rules. the more you practice, the more the rules will just become ingrained. And the last step says place them into T accounts. You understand the debits and credits side. Okay, so for this example, it says here's our chart of accounts for Angel's Delivery Services. Here's the balance sheet accounts using the same numbering schemes. The 100s are assets, 200s, etc., etc. So transaction A says Alice invested $40,000 in the business from her personal savings account. Okay, which accounts are being affected? Cash, because she put in $40,000, and it's from her personal account, so that would be the capital account. And where do these accounts belong? Well, cash is the asset, and I would have to look back just to remind myself that capital is the owner's equity. Perfect. Which are they increasing or decreasing? The cash is increasing, okay, and the equity is also going up, so that's increasing, okay. Debits or credits? Well, if I remember what happens to the cash account, it's increasing, so it means it's a debit. And I can't remember how the heck equity works right now in Chapter 2. By Chapter 6 I will, but by Chapter 2 I'm not quite sure. But I know my debits have to equal my credits. So if I have a $40,000 debit to cash, then it has to be a credit on the other side. And then I put the accounts in to these T accounts. So as I go through, I have $40,000 as a debit, $40,000 as a credit. Debits equal credits, perfect. One thing to note is I put a little a with parentheses around this so that later on, if I had to go back and track down an error, because sometimes stuff happens, I know that transaction A is part of the same thing. Okay, so that's why we actually have these in there. It's a little bit, it helps, and it's important while we're doing the course that you use these letters. I don't use them anymore when I'm doing T accounts to figure stuff out, because I still do. After 30 years, I'm still using T accounts. So this is a tool you'll use all the time. Next entry, bought a delivery truck on account, $25,000. So I'm buying it on account. On account means I'm using accounts payable, and it's a delivery truck. Okay, got my two accounts. Which category? Well, my delivery truck is an asset. It's something I own. Accounts payable, something I owe. Liability. They're both increasing. Okay, I get that. My assets are going up. My liabilities are going up. My assets, well, cash is an asset, so all assets act the same. The delivery truck, therefore, would increase using a debit, just like my cash increases using a debit. And accounts payable, I guess, would be a credit, because debits equal credits. And there it is. There's the entry. My delivery truck, debit my delivery truck, credit. If I added up all the debits, I have 65,000 in my debits. If I add up all the credits, 65,000, my books are in balance. Good. Item C. It says advertising bill was received but not yet paid. Okay, not yet paid. So if it's not yet paid, it's not cash. So not yet paid means accounts payable. So here's an interesting thing. I can think about things in terms, like think about transaction in terms of what if it was cash. And that will also give me a clue on how I'm going to record the debits or credits. So if this entry did say advertising bill was received and paid with cash for $800, well, if I said, well, I paid with cash, so my cash would be going down. So I'd have an $800 credit in my cash. The nice thing is that it doesn't matter how it's paid or if it's just a promise to pay, the credit carries across. So if I pay cash $800, if I set up the accounts payable, that's also $800 credit. However, let's go back. The second rule I said, remember, expenses are almost always expenses. So advertising expense, I'm going to take a chance to say the expense is going to be a debit. They're almost always debits for expenses. So advertising expense, debit, therefore debits equal credits. Credit's going to be accounts payable. Put the number in, credit my accounts payable, debit my advertising expense. If I add up all my debits, add up all my credits, flip the totals, debits equal credits, my books are in balance. Entry D, bought office equipment for cash. Basically the same idea. I bought it for cash, so office equipment is going up, my cash is going down. If my cash is going down, that's the credit side, therefore my office equipment is the debit side. I can do the entry with item D, cash is going down, office equipment is going up. Okay, let's see, entry E. It says I've received cash. Okay, there's my first one, cash, for delivery services rendered. Rendered means that I performed them. Delivery services rendered would be delivery fees earned. I've earned this money. I've been paid the money, so my cash is going up. Cash goes up as a debit. Delivery fees are also going up, but that's a credit. Debits equal credits. Think about that. Debits equal credits. Next, I paid salaries with cash. Paid my salaries. My cash is going down, so that's going to be a credit. My salaries is going up. That's going to be a debit. Salaries expense. Think about expenses. Almost always with expenses, they're debits. Put that entry into the T accounts. So you can see my cash account's starting to get a little bit full here. Pay my gas expense for company trucks. Gas expense, almost always the debit. Cash is going down. Debits and credits. There's my cash credit. There's my gas expense debit. Entry H. I billed my customers. So if I bill my customers, that means I haven't received the money yet. It's a promise to pay me. That's an accounts receivable. Delivery services rendered. Well, I used that account before. That was delivery fees earned. That's the revenue account. I performed this. They owe me the money. So if they owe me the money, it's accounts receivable. Now, what if they would have paid me the money? If they would have paid me the money, then my cash would have gone up. It would have been a debit. Same with any asset. Instead of saying that they paid me the money, it's actually the accounts receivable. The debits and credits are the same. My accounts receivable go up, my debit goes up. Delivery fees earned are the credits. There's my accounts receivable. There's my delivery fees earned. Oh, my PowerPoint crashed. Isn't that fun? That's a fun time. Let's see, where was I at here? And I love when technology just craps on me like this. We're at the telephone bill. Do it from the current slide. Telephone bill. Hopefully this is going to work because I don't know how I crashed, but I'll just continue on as though it is. My telephone bill, the expense, almost always expense will be a debit. There's my debit. Paid cash, that's my credit. Paid cash, have my telephone expense. Entry J says receive $1,600 as a partial payment on transaction H. Oh, looking back at transaction H, I billed a customer, so I had an accounts receivable. So if I have a partial payment, I receive $1,600 of cash. Let's start with that. I received the cash, that's going to be a debit. Okay, which accounts are being affected? Well, I'm receiving a partial payment, and here's the trick for this chapter. You don't take it away from revenues, from the delivery fees earned. What we need to do is show that at first I had this obligation to pay me. So I had an account receivable set up for $5,500. Well, now they're paying that down, so that balance of $5,500 has to decrease. That $5,500 went into the accounts receivable account. That account needs to decrease. So that's how I analyze which accounts are being used. So the cash, I'm getting really good at this. I know the cash is going up because I've received it, $1,600 debit. The other account that's affected is the accounts receivable. That's going down. That's going to be a credit. You can see here, there's the initial part. They owed me $5,500. Now I've taken $1,600 out. And if I did the balance right here, I'd say, hey, they still owe me $3,900. Perfect. And K, entry K, Alice paid her home telephone bill with a company check. Hint, you must put this entry into her withdrawal account. Okay, well, that's a pretty big hint. So she paid her home telephone bill. Okay, they told you the hint. It's a withdrawal because it's not for the business, it's for her personal stuff. So anything that's personal for the owner goes into withdrawals. And paid with a company check, so that a check is cash. And using that cash, I know that it's going to be a credit because it's decreasing my cash balance. And the other side will be a debit to her withdrawal account. And there would be the entries, okay? So now you can review this. The PowerPoint's online, but it's basically, or you can pause this video right now if you want to look at it. It's showing what the normal debits and credit balances are. Again, trust me, this stuff will all make sense later on. So now what you need to do with all of those different T accounts, all these things that are sitting here, you need to go through and foot each of them So you would foot all the debits and foot all the credits. And then if you're really, really, really slick, you would add up all the debit amounts and get a total, and then add up all the credit amounts and then get a total. And if they match, that means your books are in balance. That means it's worthwhile continuing. If you don't want to take that step, then you're kind of rolling the dice at this level. But hey, maybe you're a gambler. So you could roll the dice and say, okay, I'm just going to do this part, add up the debits, like foot the debits and credits, and figure out the balance. Okay, so you figure out the balance, good. So I go through all the different accounts, I do the footings, I figure out the balances. Okay, I'm just going to roll the dice and not add up all my debits and credits this time. So the way I can find out if everything's in balance in my ledger is I run a trial balance. So the trial balance is like a test balance. So I would take all of those different T accounts. I would list down my account numbers. I would list down all of the account descriptions. And then I would take the balances from these T accounts. So the cash account is 4912. Accounts receivable is 3900. So 49,012, 3900. I would all the debits down for my balances, and I put all my credits down for my balances. And lo and behold, all my debits balances equal all my credit balances. So this is the other way that you can figure out if your books are in balance. Before you go even any further into making statements, do the trial balance, make sure everything's in balance. Then, from the income statement accounts, in chapter 1, I said, here's the order of preparing statements. First statement you prepare are the income statements. From that income statement, you take the net income figure, then you prepare the statement of owner's equity. And then from that statement of owner's equity, you figure out the ending capital balance that goes into the balance sheet. You record the assets on one side, liabilities on the other side with the owner's equity numbers, and that will make your balance sheet balance. So let's see how it works. So I have my fees earned, $18,500, advertising expense, all this other stuff. Now here's kind of a neat thing to look at. If you just take a visual imprint of this in your mind and go over here, it's basically laid out the same way. So I've got my credit side, there it is. I've got my debit side for the expenses, there they are. See, debits and basically laid out the same way with the indent. I total up all my expenses, put it under this number, and I get my total. This is my net income, the difference between my revenues less my expenses. Notice how this is for a period of time. I have a dollar sign at the top of the column. I have a dollar sign at the top of the column. That's the only dollar sign I have. I don't put in cents for these examples. And this line actually should be a double underline. The double underlines is an important part of doing accounting and bookkeeping. Okay, so the double underlines there. I would then take this net income figure, put that into the statement of owner's equity. So I'd say, here's the capital. Now, this example is kind of bad actually because the initial capital was 0 actually. And it wasn't until she actually made a contribution. So you could say that it started with 0 and then she had added a contribution of 40,000 and then had the net income. So the net income comes from here. And then she added withdrawals, which were on the T accounts, to give an overall increase in capital and then the ending balance. But in this example, it says, here's the 40,000, that, the first entry. Here's the income less the withdrawals, net increase, Alice Angel's capital, March 31st. Notice here, this is for a time period, for the month ended. So this is 31 days of stuff that went on. Here's this number, this 54,612. This number goes over to this capital number on the balance sheet. You take the rest of the balance sheet accounts from the trial balance. So you have your cash, your accounts receivable, your equipment, your delivery truck. That's your total assets. Other side, you say, here's my liabilities. Here's my owner's equity that I got from here. And that will balance. If you go through your balance sheet and it's not in balance, look at the capital account first. Perhaps what you did was just went by the trial balance, trying to kind of rush through the lesson, and you just wrote down the trial balance number. The trial balance number will not be the correct number. If we go back to this trial balance number, go back, the trial balance number for capital actually says $40,000. So why is that, Chris? Why does it say 40,000? Well, it says 40,000 because that was the total that was put into the account. However, it does not account for the difference between the revenues and expenses or the difference with the withdrawals. So that's why we have to do this schedule. the statement of owner's equity. I do this, everything's balanced, everything's A-okay. Okay? So that's all there is in lesson 2. Feeling overwhelmed? Good. That's exactly where you need to be. You need to feel overwhelmed, and trust me, one day in the very, very near future, as you go through this, you're going to say to yourself, oh, I remember when this was so hard. Now it's just kind of tedious. So anyways, video's done. There's some other stuff on the My Accounting Lab. Hopefully the lab shell that I set up is working for you. If it's not, let me know and I'll see what's going on there. And if you have any questions, put them into the discussion group or send me an email, okay? And good luck. I'll start working on the next video for chapter 3 in the next couple days. Cheers.